Okay, our last section was a little bit more HR oriented, and this section is going to be more calculations. So if that's your preference, then I think you'll enjoy part 2 better. That's my preference. So that's why I like the FICA taxes section better on this one, but it's still stuff we have to know on the FLSA. All right, let's jump in here to part 2 of our module 3. First thing to note is just a couple of key terms that are thrown around a lot, and you definitely need to know what they are. Gross wages is what you make actually per hour. So if you make $14 an hour and you worked 2 hours, your gross wages are $28. Your net pay, or your take-home pay, it's also known as that, is what you actually have your check written for. So you made 28, but your check was only for $23.50. That's your net pay, or your take-home pay. All right, so what we're going to be looking at this week in the upcoming 3 or 4 or 5 modules. This week, we're going to look at the Social Security. So this is a breakdown of, remember we talked about in week 1, the 2 sets of journal entries that we do for each payroll. So we're going to be looking at the Social Security and Medicare part of the employee and of the employer, because they're the same. And then we're going to look at a Form 941 in Module 4. Then we're going to jump into the federal income tax and state income tax. And then finally, we're going to, one of our last segments is going to be over the FUTA and SUTA tax. And we're going to look at Form 940. All right, so in this section, we're going to dive a little deeper than what we did in week 1 and look at some what's actually taxable for FICA wages, meaning the Social Security and Medicare. So FICA means, that's the Federal Insurance Contribution Act. That's when you combine the Social Security and Medicare. Some places you may come across the terms OASDI, Old Age Survivor Disability Insurance. That's officially what Social Security is. And then Medicare, the hospital insurance. All right, Social Security. We've already discussed this, but this is just something that's really important that we have to keep in mind for this class, what the cap is for the 2021 year, which is what we're using. The $142,800, just something that you'll just need to memorize. You can see what the previous caps were and about how much they go up each year. So on average, it's about 5,000, not always. There was one year, probably about 5 or 6, 7 years ago now, that it didn't change at all. It stayed the same, but that's highly unlikely. So remember, the key rules with the Social Security is once you hit that cap in your taxable wages, remember I keep saying taxable, and you'll see why in a second. It's not your gross wage, it's your taxable wage. Once you hit that, then you're not taxed anymore for Social Security. Remember, we have the step 1 and the step 2. And we're going to practice that again today. All right, so Social Security, it pays very, very little for when you know someone that passes away. For funeral benefits, it pays $255, which is very little compared to an average funeral expense that could be upwards of $10,000. Okay, so Social Security, how they know how to raise that cap, and how they know how to determine the benefits for the weekly for your monthly paychecks when you get Social Security. It's based on this consumer price index. Okay, so what they do with this consumer price index is they get a whole bunch of items, the same items every single year, and then they add them all up. And then they compare the entire cost of that basket of goods, and they compare it to the last year and then the previous years, and see if the prices are going up. So they're going to take essential items like your gasoline, some milk items like food or bread, and then some costs like electricity that you would use, the rent, an average rent payment. They're going to use all of that, add it up, and then see how much did it increase every year. And then that's how they're going to know how much to increase your Social Security, so that you're basically not losing money. You're going to keep getting an equivalent of the same amount. I thought these were fun facts. So back in, we have almost doubled, just shy of doubling it over the last 20, let's see, that would be 22 years now from 1999. So that's this is the Social Security cap. So we've almost doubled it. Guarantee you probably wages have not doubled since 1999, but I would say maybe they've gone up perhaps 50%, that may be, but I don't think they've gone up 100% like this cap has. So that tells me that maybe this cap was a little too low. And we're gonna really dive into that next week when we look at Social Security in depth. And if they have been taking out enough, if we're ever gonna run out of money, we're gonna get into a lot of that in module 4. 1970, look how low that was back in 1970, 7,800. So 7,800, that compared to today, that's, let's see, 10 times would be 70,000. 20 times would be 140 some thousand, almost 160,000 actually. So are we making 18 to 20 times more money than 1970? Probably not. I don't think it's quite that much of inflation. I put here 7,800 is very similar to making 45,000 today, just based on what actual inflation is. It's about 5 times since that time. This comes out to more like 6 times. That's pretty close, 6 times. So this would be the cap if they were doing it with the same metrics that they've had back in 1970. So obviously they probably weren't taking out quite enough from people for Social Security back in the 1970s, because this would our cap would be somewhere around this if we were using the same comparison of dollars. And of course it's 142,000 now, 800, not 45,000. All right, our second FICA tax, the Medicare. Remember, there's no cap. The tax is smaller, 1.45%. That doesn't change. The Social Security percent up above the 6.2, that hasn't changed in years and years. Medicare hasn't as well. The only change that's really happened with Medicare is it actually has gone up a little bit for those that have made, that make a lot of money relative to where you live, I guess. But still, that's good income. This was back in 2013 with the passage of the Obamacare, with the insurance rules. Even though the insurance mandate has gone away, the mandate that you have to have it or you pay a penalty, this is still in effect, where we're not going to really cover this. I'm going to give you an example, but we're not going to deal with this kind of income in our class. Note for Medicare, the basic that you get is called Part A, and that simply covers if you go into the hospital and have a hospital stay, it's going to cover that. It's not going to cover your normal routine doctor visits, your specialty visits, or your medicines. So it's very limited in what it covers. When you add this extra percent in, it's basically like paying 2.35% on all the wages over this amount, depending on what your filing status is. Married filing joint is the only one that's a little bit higher. All the other ones, single head of household, those are just a little bit lower, 200,000. Now notice this is on wages that exceed this. So any wages up to, say you're single, 200,000 are still going to be at 0.9. All the wages over 200,000 for that year are taxed at the extra 0.9%. So your wages, sorry, I think I said before, you're taxed at your normal 1.45% wages. And then all the wages over 200,000 are taxed with the additional 0.9 on there, bringing it up to this. So this is how this would work out. If you have a married individual and together they earn 400,000, how much in Medicare tax would they actually pay? So what we do is we take the first 250 up to that threshold, and it's just at the regular 1.45%. And then all the additional money that gets up to what they actually earned for the year over and beyond the ceiling here, that's going to be taxed at the full rate, 2.35%. So the full amount that they're going to pay is the $71.50. Notice it would be incorrect to tax the entire $400,000 at this higher rate. That's what I wanted to mainly get across there. As we have definitely seen in our week 1 video, both the employee and the employer pay the exact same amount for FICA taxes. The employer must deduct FICA taxes from any employee. It's part of law. They have to do it. If you're listed as an employee, if you meet the criteria, back to our part 1, meet the criteria of being an employee, and there's no special exceptions for you, then they have to deduct Social Security taxes or FICA taxes. And then they also have to pay their own. So this is going to give us some good practice to make sure we really got this down. Let's start here. We'll just start slow. We'll look at example 2. And on each one of these, I highly recommend that you pause the video when I ask you to, solve it, and then see how you do. That's going to be the best way to determine if you are really understanding the material. It's easy, and it seems like you really understand it. If you just watch me work through it, you're like, okay, I get it. And then when you try to do it on your own, it's not nearly as easy. So start that now, and then you can kind of see where you're missing something. All right, so go ahead and pause for example 2. Okay, for example 2, we have Susie that worked 40 hours and she earns $15 an hour. This is a real basic one. Nowhere near the cap. She's only earned $20,000 this year. And so all I wanted you to do is just determine how much Social Security Medicare taxes are withheld from her pay. So that's just all we had to do is determine, okay, what is her pay? If she works 40 hours and earns $15 an hour, gross pay. And then her Social Security and Medicare, just simply taking her gross pay times the percentages. Very, very straightforward. Hopefully you got that one without much difficulty. The next one here is a little bit more difficult with Haley, the actual CPA who makes really good money. She earns $5,000 this week. And we want to know how much taxes are taken out if she has earned already this year $140,600. So we're really close to the cap. Try to think back to step 1 and step 2. And we're go ahead and pause now for example 3. All right, for example 3, we need to take into account our step 1 and step 2. So remember, step 1, all it is a yes or no question. It doesn't matter what the ending answer is. We're not carrying that forward. So a yes or no question, is the taxable Social Security over the limit? And the answer is yes. If you take $140,600 plus $5,000, it's yes, over the limit. Now, it doesn't matter what this number is as long as it was over, and we forget it. We move to step 2. Step 2 says take your cap number minus what you currently have made already, and then whatever the difference is what's left to be taxed. Okay, so we're taking the 2,200 instead of the 5,000, taking the 2,200 times 0.062. Medicare, there is no cap. We're not up to the 200,000 mark either, and we won't be even with this pay. So it's just the regular percentage. All right, for example number 4, what I want you to do is combine examples 2 and 3, but tell me how much in total this company would have to pay to the IRS for FICA taxes. Now that what I say is in total, so that means the employee and the employer portion. Go ahead and see what you get for that now. All right, hopefully you've paused it and you came up with your answer. What you need to do is just take example number 2, add these up and multiply it by 2 because the employer is going to have to pay the same amount. And then add these up and multiply it by 2 because the employer also pays that. And that's all you've got to do to get your total. Hopefully your final answer was $509.60. So all I did is I took ×2 for each of these and then came up with a total. So employee number 1, employee number 2, Social Security and Medicare, and then what the total Social Security, what total Medicare was. All right, our last little example here to make sure we've got this down. These, we've got 2 very well-off employees here, Amy and Bob. Both have prior wages pretty high up. Current taxable wages are given. All the wages are currently taxable. I want you to be able to tell me, determine the Social Security and Medicare taxes for each employee and journalize the employee's payroll entry. So we're going to think back. All you're going to do is journalize the FICA taxes portion, because I don't give us any of the other information like state or federal. So I want you to be able to think how much Social Security is taken out, how much Medicare, and then do the simple, then do the journal entry with just that information. All right, so go ahead and pause now for example number 5. Okay, for example number 5, first thing we come to, the first one we come to is Amy, 139,600. We're definitely close to the cap, and when we take step 1, added the 7,000 in, we are over the cap. So we're going to forget that number. We're going to jump back to the cap number for step 2, 142,800. Subtract out her current wages. That's how much she is going to be taxed at 6.2%. Now for Bob, Bob's already over the cap. So we don't do anything. He's already past 142,800. So none of his wages are going to be taxed for this pay. So when we come down here, we got our payroll register, and I put in here, this is just a little mini payroll register. Their wages, how much of their wages is taxable for each. So for Bob, nothing. For Social Security, only 3,200. And then we can calculate their actual tax, taking the 3,200 times 6.2%, and then taking the entire 7,000 times the 1.45%. And then for Bob, no Social Security, because none of it's taxable, but Medicare, the full amount, 1.45%. And we can then calculate by subtracting out their taxes to see what their net pay is. And then finally, we can do the journal entry, the condensed journal entry. But that's from what the information we have, this is what we can provide. Their wage expense, their actual gross wage, and then crediting the payable items that are taken out of the employee's check, and then what we actually write them their checks for, both of them combined. And then the employer's part. We wouldn't even have FUTA and SUTA for these guys because they are well over the cap already, over the 7,000 and 9,500. Okay, so as you can see with this extra piece over here, employers would love to be able to avoid that. And so they try, if it's close, they'll try to make a lot of employees independent contractors. And then when they're an independent contractor, they don't have to pay the taxes, nor do they even have to take it out. They don't have to calculate it and take it out of the employee's check. So just think back to our previous part 1. Are you an independent contractor or not? And you don't have to meet every one of these, but basically if you meet over half of them, then you're probably an independent contractor. And the ones in yellow here are, I would say, the highest that I would, in my opinion, consider you a independent contractor, but not any one of these by itself make you an independent contractor. These are just some of the, I think, would weigh a little bit more. All right, so if you do knowingly misclassify, you are going to have to pay back taxes, and it's just something you want to avoid. All right, so the employee ID number, that's what an EIN is. If you ever hear of an EIN, if a company has an EIN number, it's just like a Social Security number, but for companies. And so a company would have to put this on all of their tax forms. As soon as you have at least one employee, you have to have an employee identification number, an employer identification number. Okay, those who are exempt from FICA taxes. So these are employees that you have working for you that fall under a special exemption. All right, so most of these are kind of rare. They're not going to happen too often. So we're going to just kind of go through these pretty quickly. If you're a student at your college, so this could be common for those watching this, and you work less than 40 hours. So if you happen to be a student employee, then you wouldn't have FICA taxes taken out. If you're a household employee, meaning like you're a nanny, perhaps, and you earn less than $2,200, that's for the year. So that's pretty low. Then you wouldn't have to have FICA taxes taken out. Otherwise, notice, I mean, that's pretty low. Once you make over the 2,200, I think it's 2,300 now. I'm going to update that. I believe that was one of the switches I had in part one. I just forgot to change it here. 2,300 for part one. For household employees, again, not a big difference. But if you were a nanny and you were in their house and you basically had to do what they said you had to do in taking care of the kid, then you're technically an employee and you should have taxes taken out. Now, I don't know that happens all that often, but that is the technical rule. All right, some common taxable wages. These are we're going to start getting into the items where I said there's a difference between gross wage and taxable wages. All right, now these are just the common taxable wages, things that if you get money for doing this, then it's still going to be taxed. All right, so of course your salary and normal pay, hourly pay. If you get paid ahead of time, still taxed if the employer prepays you for whatever reason or back pays you. Bonuses are still taxed. Dismissal pay. If you take vacation pay instead of vacation time, that's going to be taxed. Or if you are getting paid while on vacation, that's still taxable. Pay that you get while you're sick, still taxable. So most of the time it's taxable. Most everything is taxable. If you happen to get some really nice perks, like maybe the use of the company car, they allow you to drive it around just for personal purposes. The value that you are using that car, and you would have to come up with some, all right, this is the retail value of this car spread out on a daily basis. They would have to add that into your taxable wages. Even though you're not technically getting paid, you would still have to pay tax on that. All right, so money, this one is the big one that is different between FICA and federal income tax. This is the biggie. When you put money into a 401k, it's still gonna be taxable for FICA. FICA, you gotta think about, FICA doesn't care if you put away money into a 401k. They're still gonna treat it like you have the money. And it's going to be taxed right now on your paycheck. Now, the good part is when you then take that money back out when you are retired, FICA has already taxed it, and therefore it's not going to be taxed again. Okay, so at least that's something okay, good, that you're not double taxed on it, because that would be really bad. Now, federal income tax takes a different route. They say, no, we're not going to take the taxes right now. We're going to pretend they're not even there. So we're not going to, if you put $100 in, and let's say you had earned 1,000, well, we're only going to pretend that you made 900, and then we're only going to tax you on 900. Whereas Social Security is going to tax you on 1,000. So for federal, and this goes for state as well, they're going to say no tax, but when you take the money back out, when you are retired, then we are going to tax you at that point. Let's see here, tips. Tips are definitely taxable. So if you have tips and you're a waiter or waitress, You have to report that to your employer. They would have definitely have told you that by now, and you should be familiar with that. But you do definitely have to report it. Cash tips and or credit card tips, all of them. All right, now some of the biggies for that are not taxable. And these are the ones you just kind of got to memorize because there's not that many of them. So by default, you always say everything is taxable. And then these are the few exceptions. All right, so money you put away to pay for your medical insurance premiums that you tell, yes, the employer, I elect to go into this and it's going to take out $120 out of my paycheck to pay for medical insurance premiums. That money is never taxed. So it's it's like the government or the FICA or federal doesn't see it. And so therefore it's not taxable. Money you put away into your FSA account, which is known as a flexible spending account. And this can be for money that you put away to pay for medical bills or money put away to pay for dependent care. So care that you pay for like a daycare for your kid or after school care can be used with this fund. So that's money that you put aside, you know that you're going to use it for that specific purpose. And that's the only purpose it can go towards. But the government won't tax you on that. So that's a nice benefit. At least you won't be taxed on those expenses that you know are coming up. Health savings account is just like a flexible spending account. The only difference being with a flexible spending, it's a use it or lose it. But anybody can have one of these. The health savings account is only for those with a high medical deductible for their insurance. And it doesn't have dependent care. With the health savings account, it's not a use it or lose it. If you don't use it, you can carry it over into a future year. Whereas a flexible spending, you need to be pretty conservative and only put away the amount that you're for sure that you're going to spend so you don't lose any of the money later. All right, so again, the employee contributions to a deferred compensation plan. This is one we talked about just up here. This is not taxed for federal, but it is taxable for FICA. That's the one we really got to remember. If your company or you put away money for life insurance premiums, especially the part that the employer's paid, you're not taxed on that. You're getting basically a free benefit, free tax-free benefit. If you have meals and lodging at the employer's convenience, basically that means you get free meals or lodging. You're not going to be taxed on it if it would be a deterrent to the employer if they were to allow you to get your own meals and lodging. Meaning, if you were out on an oil rig, it would not be definitely feasible to fly you back to the coast to have you do your own lodging. So therefore, they're going to provide you with a bunk and some meals. But since you don't really have any other means, then it's tax-free. If they provide you meals and lodging, let's say they give you free lunch every day at the cafeteria, that is taxable. That would be considered taxable. All right, let's come to the employer paid educational assistance. Even if you don't work for a college, the employer can pay up to a certain amount. It's just over $5,000 every year, and that can be free money for you as long as it goes towards your education. So they pay it basically directly to the institution. Then that's free, tax-free money to you. Otherwise, if it wasn't for this special rule, you would be taxed on that extra up to $5,000 that you got. All right, so what I want us to do is begin to look at the difference between gross wage and taxable wages. So we've got what we've got over here is our taxable wages. This is our prior taxable wages after taxes have already been taken out. And then I give you current wages, current gross wages. So you're going to have to take this amount and determine which of these items down here are deductible and which are just items that you can't deduct for but are still taken out of your check. So I'll give you a hint. If you put money like $100 into a charity, say you wanted to pay into United Way, you wanted to give $100, even though the employer is going to take $100 out to give to United Way, they're still going to tax you like you made the full amount. They're not going to take away $100 and not be taxable. All right, so you can use your payroll register. That may be a big help to you at this point, or you don't have to if you don't want to. This is just a practice example. But I want you to determine what the taxable wages are for Medicare and Social Security. Then complete the register and determine how much tax will be taken out. And then finally journalize. So let's go ahead and pause for example 6 and let's see what you come up with. Okay, I've got the answers up for example number 6. I went ahead and did this in the payroll register, very similar to the one that we have made in class. The only difference with this one is you just go ahead and type in the prior taxable wages because I give it to you. Most of the time, we're going to use the prior pays to figure out. So we would type in the number of pays. But since I give it to you, we can go ahead and fill these in. I don't give you the prior gross wages, so that's why I left those blank. All right, so the next thing we do after we have these guys in, these are to help us if there's any caps involved, and there will be with Dylan because he's very close to the Social Security cap. First thing we want to do is put in our current gross wages, but knowing that these are not what we're going to use to figure our Social Security and Medicare tax. What we're next going to do is come all the way over to the right-hand side and start filling in these guys. These are the ones that are, and if you have properly filled out your register, you would, for FICA purposes, as I'll go back over here, for Social Security, I didn't put in I put in the formula for this guy, and for these. For this one here, I do the Medicare because Social Security could change based on if there's a cap hit, in which there is for Dylan. But I say, okay, take your H2, your gross wage, and then subtract out S2 and T2. We don't subtract this one out because that's only for federal purposes. Do we put that guy in? So if you don't have your payroll register updated at this point, you'll want to go ahead and do that to your basic template, not just to this example, but to your blank template. Put in a formula that says, okay, anything for medical insurance gets taken out and it's not going to be taxed. Anything for flexible spending or health spending account gets taken out. Anything other like child support, donations, that's just a thing that's taken out of your paycheck, but it is still taxable. So that's why it's not subtracted. So when you subtract out these two amounts, which comes up to be 420, that's how I got the 2080. This is the number that's going to be used when I do my Medicare tax. I'm going to take the 2080, not the 2,500, times 1.45%. And I'm going to take the 2080 because the Social Security is going to be the exact same as Medicare unless a cap is hit, which it is for Dylan. So let's go over here. We put in for Connie 170 taken out for 401k, 220, 200 for medical, and then 180 for child support. That would be one of the others. That is still money taken out. We don't get it as the employee, but we don't get a benefit for it either. We don't get lower taxable wages because the lower your taxable wages, the better. 750 for Dylan taken out for 401k. He has a lot of just the normals, 500 for medical premiums. Then he has dependent daycare. That's fine because it's a flexible spending account. The part here that I put that the employee matches the 401k and medical premium, that's going to be part of the journal entry. But these are what's considered cafeteria plans. And these are freebies, basically. You're not taxed on them. If the employer gives you free money into your 401k, great, you're not taxed on it. Now for this, you will be taxed on it when you take it back out when you retire. But it's not taxable right now by any means. And then money that's helped to pay for your medical premium insurance, that's never taxed. That's a freebie, tax-free benefit. So the same would go for Dylan. Now, the only thing special with Dylan is we will have to figure this, and we're going to have to do the step 1 and step 2. So step 1 and step 2, step 1 says, yes, we are over the cap. So we need to come down to step 2. We take the cap minus where he is currently at, which is 140,800. That leaves us 2,000 left. So that's where this guy comes in as 2,000 and not 5,900, which would be taxable. Even though he made 6,900, that's his gross. You want this number to be as low as possible. I grayed out the federal taxable wages for now. We'll get to that in our upcoming modules when we get to federal taxable wages. We'll uncover that. Okay, so these are the two amounts that you should have got for your total, Social Security and Medicare. The journal entry, just a very basic one on this one. We don't have these guys yet. And then we take out their other items. And we're down to our final cash payment of $65.11, which matches the journal entry. It still totals. Or you could look at it a different way. You could say, do my credits. When I add all of these together, if I look down here, the sum is 9,400, and that's what this guy is. Payroll tax expense, they are both well over the FUTA and SUTA, so that's why these are 0. These guys are way over 7,000 and 9,500. Only thing is to double, or not double, but just do it twice, these Social Security and Medicare. And when you add those two together, that's our payroll tax expense. And then the last two items are these. If the employee matches the 401k and medical premiums, that's coming out of the employer's pocket. So when something comes out of the employer's pocket like this, and they have to pay in addition, that's an expense to them. And then that's money that they owe to whatever company it is. So maybe TIAA-CREF or the Hartford Retirement Company. So a 401k expense, it says the employee matches. So whatever the employees together put away, the employer is going to match it and pay an extra $920 out of their pocket. And it also says the employer matches the medical premiums. So the employees had to pay $720. That means the employer is going to kick in an additional $720. These extra benefit plans is where it starts to get real expensive for employers. And so they'll try to minimize these, but they know they have to offer them. Otherwise, they won't be competitive and get the really good employees. All right, for journal entry number 7, this one's a little bit, I mean, this is kind of looking at it going forward now. Instead of in our past examples, we paid our bill up front, and then we collected more, and then we would have paid it in the next example, perhaps. In this one, we're kind of looking forward and paying our prior amounts. We're going to go ahead and pay them now. So whatever I didn't give us any opening balances. So basically whatever was put away this pay period, that's what we would have started on our T accounts because I didn't give us an opening balance. So altogether we owed $505.92. And so we're going to pay it off. We're going to debit $505.92. Medicare, $231, and medical premiums payable, I can tell us we're going to pay that one as well. Assume the medical premiums and the FICA taxes are paid. So the medical premiums, $720 from the employee's benefit, from the employee's part, $720 from the employer's part, a total of $1,440. We're going to pay that off. So altogether, we're going to pay out this $2,177. All right, so that was a nice long example. You may want to go back and review that at any point. I think that would be helpful, but we're going to go ahead and move on. We're going to finish out this here in the next probably 5, maybe 10 minutes at the most. Self-employment. If you are an independent contractor, you cannot get away from FICA taxes. It's even worse for you. And we'll look at why. Okay, first off, self-employed people pay FICA taxes on their bottom line, their net income, not on their gross revenue. So just because a company bills 1,000 doesn't mean that they pay net income on 1,000. Doesn't mean they pay taxes on the 1,000. They pay taxes on the net income. Now, it doesn't actually matter from the owner's point of view. If they took money out of the business, they might think, oh, I'm only taxed if I take money out. If I leave it in the business, therefore it's not taxed. That's not the case. You're taxed on your actual bottom line net income. If you're doing a Schedule C, which is a sole proprietor, you're taxed on your net income. It does not matter if you took money out of the business or not. You have to prepare this Schedule SE for self-employment tax. I've got an example, but I don't know that's really that important to go through right now. That's more of a tax for a federal income tax, and you definitely go through that. But as an independent contractor, you still have to pay your FICA taxes and your federal withholdings, and you actually pay those on a quarterly basis. And how you do it is you pay it on an estimate. You have to kind of look at your books because you don't know exactly what your final net income is going to be at the end of the first quarter, because, well, you still got 3 more quarters left of the year. So you pay on an estimate what you think it's going to be. And then if you underpay, you're going to have to make up the difference and possibly penalties if you didn't pay enough. So you don't want to underestimate it too much either. If you overpay it, no big deal. You can get the money back. Now, the bad part. The bad part is the same percentages apply, but you have to pay both. You have to pay the employee part and the employer part because you are both. You're the employee for the business and you're the owner as the employer. So in Social Security, you've got to pay 12.4% and Medicare 2.9%. That's the really, really bad part. This should say 142.8. I'll get that updated. So if you make over the cap in another job, then you won't pay any Social Security in your private business that you have, your own business. So it's still the same cap, and it's still based on total wages, not just wages in each individual company. It's total wages. And then if you make, let's say in your other job, you made 139.9, you're really close to the cap. That means only 2,900 of your private business would be taxed at Social Security. The other net income would all be taxable for Medicare because there is no cap. All right. So self-employment, it's not good for the employee part, taxes wise, for self-employment, just because you have to pay double. All right, the last things we're going to look at is, well, companies have to pay the FICA taxes and federal withholdings, but how do I know when? How do I know as a company when I have to pay those? Well, we're gonna figure that out here. You first determine for federal and FICA taxes, you have to look at your look back period. So your look back period is the 4 quarters ending in the most recent June 30th. Okay, so think about when June 30th falls. For most of you watching this, the June 30th will be June 30th, 2021. And so that would kind of be your cutoff date, June 30th, 2021. And then you're going to look back through, this would be, let's update this, July 2020 through June 2021. So you're going to look back the year prior, starting with that June 30th, 2021 date. You're going to go back a year. And that is going to be your look back period. And what they're going to do in that look back period is they're going to figure out, and you will figure out, how much wages, how much taxes did I as the company withhold from all of my employees plus my part, the company's part. How much did I withhold? And then I've got to compare it to these amounts. So if I withheld and had less than 50,000 due throughout the entire year in federal and FICA taxes, then I deposit every month. as the employee, as the employer, I have to make a monthly payment to these guys. And generally, instead of writing checks or anything like that nowadays, you pay electronically through this EFTPS form. And there's a little form you fill out, and then you get on a payment plan, basically a setup, and you go in and it's an automatic withdrawal from your business banking account. If you're a new employer, you obviously won't have a look back period. So therefore you will automatically be enrolled as a monthly until the next year when you may become a biweekly. So a biweekly is for any of those who collected over $50,000 in FICA and federal income taxes during this year, this look back period. If you collected over $50,000, you have to pay every other week as a biweekly depositor. And then if you're a really, really, really big company, and at any one time you have over 100,000 stashed away, ready to be paid to FICA and federal withholdings together, you have to pay it by the next day, the next business day it is due. Okay. And if at any one time you were ever a monthly reporter and you have collected over 100,000 that haven't been paid yet, you automatically become a biweekly by default. So if you're a brand new business and you're really, really big already, and you've collected a lot of money that's due, but you're only paying it every month, as soon as you crack that $100,000 mark, which would be very, very high, you'd have to have a lot of employees, you will automatically become a biweekly depositor. Now, for the very, very small businesses, so we're talking usually like one employee, maybe two at the most, if you collected less than $2,500 in the quarter, then you can just pay at the end of the quarter instead of at the end of the month. And you can pay it with your 941. That comes to our last part, which is, okay, well, what is Form 941? Well, we're actually going to get into that at the very beginning of our next module. But just to give you a brief preview here, the 941, for payroll purposes, it's to help to make sure that all of the money that is taxable is actually collected and then paid on. It's kind of like doing your individual 1040 that you do every year. It's a kind of a summary and to make sure you and the IRS are kind of equal and that you didn't have anything taken out or that they didn't know about. And so if there's a possible refund or if you owe more. But the Form 941, we need to memorize that this is submitted every quarter for 95% of the businesses out there. Okay, so just remember 941 is every quarter. And if you're one of these guys down here, very, very small, that you have less than $2,500 in taxes for the whole quarter, you can pay that with this form and do it at the exact same time. Notice here when you have to fill out this Form 941. So your quarter goes from January to the end of March. And then you have until the last day of the month following. So you would have until April 30th. You get a little bit of a benefit if all of your prior deposits were made on time. So if you made all of your monthly payments on time or your biweekly depositors on time, then you get an extra 10 days. So you get until April 10th. No, you get until May 10th for that first quarter. Because your normal due date would have been, if it ends March 31, it would have been April 30th. And if you made all of your payments on time, you get until May 10th, an extra 10 days. The one little tiny exception here, you don't have to file a 941 every quarter. If you owed less than $1,000 for the whole year in employment taxes, which would be, you'd have to have an employee who was basically part-time and did not work very much to meet this. So that's why I said like 95, maybe 98% of employees are going to do the 941, as long as you're a regular for-profit business. All right, we're actually going to look at how to fill out the Form 941 next week. It's one of the more complicated ones in a few parts, especially when the Social Security cap is hit. And so we're going to really take a good look at that. And we're going to update our payroll register to reflect the 941 as well. All right, with that, I will see everybody in Module 4.